part 4 of the A to Z project finance modeling online class. Let's see if I can get that out. I've really had trouble just getting some words out today. Now this, for me, it seems a little bit out of place. I'm going to talk about depreciation, taxes, and I really should have called this after-tax project IRR. Now, normally I tell people project finance is all about cash flow, cash flow, cash flow. So one thing you don't have to even worry too much about is getting a profit and loss statement together. You don't have to worry about a balance sheet too much. And the only thing that really the accounting affects is the taxes. That's kind of true, but there are real advantages of putting a profit and loss statement and a balance sheet in your model. And in order to get there, you're going to have to model some depreciation. Okay? We're going to, in this case, before any financing, we're going to get the taxes and the depreciation together, mainly the depreciation. Okay. I said the effects, there's some interest during construction affects the depreciation and affects the taxes. We want to get a pure after-tax cash flow that's not affected by anything in financing. So we computed pre-tax cash flow, after-tax cash flow. This is kind of like the ROIC, the no PAT, the no plat, and all that. Now, after we get this, we can put together depreciations. Depreciation. Normally, I have a little advanced thing in my videos. This time, we're going to get to the one kind of advanced thing very quickly, but I want to tell you first that just because it's project finance, different principles of accounting don't apply. If you have a major overhaul that occurs in 20 years, but it lasts longer than 1 year, that is capitalized, not expensed. When you get to that year, and when you get to the financial statements, that will be capitalized, and that will affect the taxes. And if you take a resurfacing expense that's going to last 10 years, and if you account for that as an operating cost, that's not correct. And if the taxes follow the book depreciation, then there's going to be an error in cash flow as well. So we're going to talk about a little bit different tax depreciation, and I'm certainly going to show you the tricky part, which if I don't know how many times I've got this wrong. I don't know how many. Whatever. I'm going to continue. If you expand wells, if you put inverters in a solar project, if you have overhaul cost, any kind of extraordinary cost, you have depreciation. And let's say you make all this overhaul cost 5 years from the end of the life of the project. You better not use a depreciation rate of 20 years, and you better find out what the tax depreciation treatment on such an expenditure would be. And I don't claim to know all the taxes. There can be very, very complex taxes, especially when there are different countries involved and everything else. But in general, you should know that taxes have to come in one way, even with Donald Trump. They have to come from depreciation, accounting. He's going to eliminate depreciation, but you still have to write off. That's writing off an asset in 1 year. Good. Okay, whatever. Okay, I think that's what I read in the paper at least. Now, we're going to one of the things we're going to do is model the capital expenditures that could come from these replacements way into the future. And that, unfortunately, I'm really sorry to say, that if we want, it's like the V lookup or the H lookup that had that little false option. Or the match has a false option, and unfortunately, we're going to have to get, it says, get the lookup. I guess we can use the match function to get a true false, and then use the lookup to get it into the model. I'll see. Now, here's the real pain. The real pain is if you go to, I'm going to skip down here for a minute. This is disgusting. What a bunch of crap. Sorry. I'm talking like an American. What a bunch of rubbish. If you have straight line depreciation, there is absolutely no need for a table like this. All you're trying to do is show your prowess in Excel. And if you want to retire the assets, you just put a minimum function in there, especially if there's kind of one asset that's being constructed over time. Otherwise, you could use an offset function that I've done too much. Now, there is a problem, though. Here is the problem. If you have a remaining life, that does create a problem, because essentially every time you put in a new expenditure down here, I don't even, this seems to be, I don't know if this is straight line depreciation or what. There's no excuse for putting one of these tables in, but unless you have these rates that change over time, if you have changing rates over time, then you have to kind of accumulate when you put the Capex in and what the new depreciation rate is, and then get a sum. And there's no, look at this thing. What is this? How could you possibly say that that's okay? I can't remember where this one came from. Okay. Now, there's one thing. I'm skipping. I'm not being totally structured. I'm being a little more flexible. Sorry. So we're going to go through and show you how these user-defined functions for depreciation can work. And all I'm going to do is import these things. Okay? Now, and that's really the complicated part of this whole thing. Getting together a plant balance, putting an opening balance and a closing balance isn't too complicated. But, oh no, I'm going the wrong way. Excuse me for this. But think about a development fee. You pay a development fee to a third party. I had a case in the Dominican Republic where a developer wanted something like 500 USD per kilowatt for his development fee. That's more than the cost of a module, a lot more, half the cost. Whatever. And he said, I spent this money, I made 50 different projects that didn't work. I finally got one that worked. I want to recover all my profits on the one that didn't work. Fine. Economically good principle, no problems. So you pay that developer this big amount of money. You, as a sponsor, pay him. He records a gain on the sale of asset. He records a big capital gain. I don't know exactly if he'd record an ordinary gain, a capital gain. It doesn't matter. He sells his project. He only invested a small amount in it, and he records a capital gain. And you put that purchased development fee on your balance sheet. That's okay. Now, if you sell it to yourself, do you think there's a different treatment in accounting cost? You wrote up the asset. The development fee is an asset write-up. And tell me, in accounting, if you have an increase in the asset write-up that didn't cost you any money, there's no way that that's not an income item. And how that's treated for tax purposes could be a big issue. And if you depreciate a development fee and don't call the development fee income for tax purposes, you've got to start asking some questions. What's the matter? Okay. Now, here, if the development fee is taxed, think about this. If the development fee is a taxable item, then I'm obsessed about these development fees. Sorry about that. It's just a complicating thing in a model. if the development fee is taxed and then you take depreciation on it later on, what that means is it's a negative for tax purposes because you pay taxes today on the gain on the development fee and you'll get a deduction later on. That's not a good strategy. If you need the development fee to get more debt, it might be very good. So the tax treatment of this development fee comes into the model, and you better ask some questions. So let's talk about owner's costs. Let's talk about the CEO's salary. He wakes up, he, not she, he wakes up one day and says, I thought about this project last night. I've got 20 gazillion projects, and I thought about this one. So let's allocate half of my salary to this project. That's good because you get an increase in the project cost, and you get, if you're using a debt to capital, you get an increase debt. Oh, good, you've tricked everybody because you were going to pay his salary anyway. Everybody knows that. But think about it for tax purposes. If you record that salary as a Capex, that Capex gets depreciated really far down into the future, whereas if you just record it as a salary expense in the corporate accounts, it gets recorded as a deduction today. So think about these things. All right. So I've already talked about a couple of the errors, and I've gone through this thing. And here's one thing I didn't address in this, which is the expiration of tax losses, the NOLs. We're going to show you NOL because it's a nice, easy min-max example. But, if the NOLs expire after 5 years, you have to go back and track when those NOLs came into place because, you get to you have to do kind of a vintage analysis, and that's really not easy. That's one of the hard things in modeling, and I'm sorry to say that I'm not doing it. I'll do it in a separate kind of thing. So here we're back to our debating what to call this. I think I might leave it as David Lee. He's the one who asked for this. I kind of wish he did. Well, I don't think so. So I have depreciation and taxes, no titles. So when we left off, and I was wrong here, I have the titles here. So when we left off, we stopped with pre-tax IRR, shift control down arrow a few times, control minus. That's our no title one. That's the one you should remember right now. Turn off the video and try to do it yourself. Well, it might be a little tough. So I'm going to begin now. What I did here is added a couple of inputs. And the only input I added is this thing on prospective replacements. And I said, well, let's not make some idiotic assumption that they always occur in the same kind of period. And I obviously, no. Let's say this occurs in year 22. So then we make an e-date function that says this is from the year of replacement. I multiplied it by 12. Sorry if I didn't put 12 months. And I just made some kind of arbitrary assumption. And I have to press Shift Control, Shift Alternate C to get a. Oh shoot! Oh God!
Oh bonjour!
Oh. Now, after the replacement capital expenditures, or the whatever we call them, these capital expenditures that occur after the life, then I put some inputs for depreciation and Capex. You can tell this is really exciting. Now, I did something that's kind of bad. I put a variable declining balance factor. And this is for this thing called double declining balance. If we have it, if we put 1, it goes back to straight line depreciation. And you can use this, you have to put a 0 here. And if you take, I said if error, because if it's after 15 years, it puts a num. And then I said, well, take a variable declining balance on a 1, investment of 1, with a salvage of 0, with a life of 15. Use the opening and closing here, and then use the factor of 2, excuse me. If I put 1, you can see it goes all the way to year 15 and gives you straight line depreciation. The reason I'm saying this was kind of a little bit perhaps U.S. oriented, but now they're changing it. It's obsolete. Whatever. Let's put this 21% corporate tax rate in there. And now on the development fee, I emphasize this or not emphasize this. I talk about it too much, but perhaps it's taxable. If it's taxable, two things happen. Number one, we get taxed when we have a gain, and number two, we get to depreciate it. If it's not taxable, you don't pay a tax on the gain, and you don't get to depreciate it. So those are my tax inputs. How exciting. And then now let's move into the modeling. Now, in the modeling, this is where we ended up last time with our pre-tax IRR of project IRR of 6.69. I'm going to put some Capex in, the normal kind of Capex, the owner's cost, put the age of the project in years, not in periods, because we need that, because we had the depreciation rate over here. And we have to make it long enough so that depreciation eventually goes to zero. That's why I used the if error. How exciting is that? And then so we get the age in years and the depreciation rate, and then we multiply the balance by the depreciation. Now, I put development expenditures separately because it's got a different tax treatment. And there might be a deductible. Now this, whether it's deductible or not, depends on this little input I just talked about. So if it's false, we don't have any deductible. We don't have anything to deduct. Now, we're going to have a book gain no matter what. Oh, God. Just a second. Okay. So, that's what we'll do. And then I'm going to put in this added capital expenditure. And I put the added capital expenditure way up here. It was a little bit out of place because I already did the calculation. So I have to undo that calculation. That's going to be a little bit of a tricky thing. And then we'll put our added capital expenditure, and then we have this business of computing the remaining life on our depreciation expense. And that's going to be where we're going to have to go and import another user-defined function. So we don't have one of these immense vertical or whatever diagonal vintage things. Okay. And then we'll get our total depreciation. Will only, no matter what, I wouldn't take any depreciation on the development costs here because that's kind of almost a financing related thing. We're not going to put any additional cash flow. And then if we have negative earnings, negative EBIT, we should carry it forward, because if you have an all-equity company, you carry it forward anyway. And then we'll finally get our adjusted taxes. This is taxes without any interest. And then we'll get the IRR computed. And we should put it here, not at the end. Okay, not like companies, somebody like Morgan Stanley. Okay, so I'm just going to go up and find the capital expenditures first. And I have the total outlays for construction. This does not include development costs, at least I hope it is. Okay, well, I kind of did it wrong. So let's take the total construction amount. And then let's take the total owner's cost. And I'm repeating myself, but I want to repeat myself just a little. That's your CEO's salary and all that. And that's kind of, you might not want to capitalize that if you could expense it otherwise. I don't know how much choice you have in accounting. I don't know how much the accountants are going to restrict you, really. And then we put the age in years. Now, we could have put the age in periods over here and then did our little roundup thing to get the age in years. But I'm just going to remind us what it was. And then we use our lookup function again, and we go up to the age in years, and then we go up to that depreciation calculation. We put in the tax area, and you should be saying, it's not that hard to find this stuff, because there should be a separate kind of area, and the model should be all structured for what we're doing. And then to get our periodic state thing, we divide it by 12 and multiply it by the periods in the year. Now, you could have also had a straight line depreciation where you would just begin the depreciation, just divide it by the kind of life in periods, and begin the depreciation right at the commercial operation. So now we have it's hard to get things out, multitasking in my little bit old age here is not so easy. Hey, let's put our development fee here. Okay, and then we'll get our closing balance. You can press Alt equal if you want here. I put a little shortcut in for Alt equal. I did a couple of other, I adjusted the generic macros just this morning as well. So we can take our development fee depreciation. Now, here's the big thing. If it's not deductible, then we take that amount and multiply by this little switch, so we can turn that depreciation off, and we have to keep. The only reason we need this book stuff, this is just our development expenditures lead to a book gain, and then we can, I'm going to suppose, I think this, one of these companies that gets all obsessed with the rules says, well, you should always take it from the top, I guess, so you can find it easily. I don't know. Maybe, perhaps. Okay. Now, let's talk about our added Capex just for a minute. And I put that together with the Capex up here. So we first put a switch for when we have these Capex occurring, and this is where lookup doesn't work. So we use a match function. We use the match function, and we said, well, okay, I'm going to match this date. It's kind of just like the lookup a little bit, and we find where I put those replacement Capex, and I match this date against those dates, and then put a comma 0. So that's like half, perhaps, of the thing. Now, if you go across, if we really went across, eventually we'll find a place that's not where we have just we have a 6 here. Okay. All right. And then we can, what I would suggest doing here is putting just we can put an if error. That's kind of the easiest way to do that. If error. So if it's an NA, that's an error. Then we will put in false. Okay. So we almost have kind of a true and false. Now, once you have that, you could then just use the lookup function again. Why don't I do that? You could have also used the index with the match. But we can use the lookup on our date. And as you get used to using these functions, it should start to get easier. Okay, now the problem with the lookup function is, it gives you an NA there, first of all. But it gives you all NAs until we find the first one. And then it doesn't stop. And it doesn't stop. And so since it doesn't stop, we could put an if statement up here. If it's false, if it's true, then we take it. Otherwise, we put 0. I didn't even explain that very well, did I? Because I don't even know it's going to work. So I use a lookup together with a little bit of a match. That was a harder one. And let's see if it really worked, or if I was just giving you a kind of a bad advice. Here, yeah, we got our first one in, and of course we could multiply this by an inflation rate and all that, and we got our second one in, and we forced it just with the 1. So you kind of need this little match with the NA to do that. There are probably 20 ways to do that, but I haven't found a nice little way. You could use the match index with the false. You could do a whole bunch of stuff. Okay, so these formulas a little bit long, but that's about it. That's about as long as hopefully we'll have just about any formula. And you can kind of look through. We had some lookup statements, and we had a little bit of if statements here and there, but not too long, hopefully. Okay, and then now we can take this is really the hard part of the video, by the way. That last one, I don't know, is a little bit tricky, I think. And then we go, and so we get our future capital expenditures. And then we can press Alt equal to get our current Capex. Now, here is the, if we say these occur at the end of the period, we can use the count if. That's part of the things I say it's fine to use. And we can take a count if and click on the kind of go forward and then put comma true. And what that does is it gives us how many periods are left. Did I do that correctly? I did that incorrectly, because I want to know how many operating periods. So we click on this one, and then we click comma true. And it says, I have 120 periods left. And now I'm going to compute the depreciation on those new capital expenditures, but I might want to use the remaining life. It might be if those expenditures occurred near the end of the life, I cannot use a normal old expenditure. I have to use a future expenditure. Now, before we do that, so that's the hard one. That's the hard one. So let's first just take all of this and press Shift Control R. So get that copied. That's part of the generic macros. Okay, if you don't like those generic macros, whatever. Do it your own way. Okay, but why wouldn't you just, I know if you're an artist with Excel, you might think I can do it differently. Okay, so now we let you see our remaining life begins here and then eventually goes down, and when the remaining life is less than our depreciation, we can stop. So now I'm going to put a maximum life of the project. So let's say our tax people, and this is perhaps it's a little bit inconsistent with the depreciation here. But we'll use this. I'm sorry. I'm just going to use this 15. So if it's, but then remember we had this is 15 years, and we can put it in periods. So let's put periods here because those that remaining life depreciation. I'll put max life on replacement assets. Okay, now I'm sorry I kind of added this in here, but whatever. And we'll put periods because now I'm going to have to go and modify my other thing. And we'll take this and divide it by 12 and multiply it by, we multiply it by, if we have a periods per year, we multiply it by the 3 to get how many months of depreciation. So whenever our remaining life is bigger than 45, we'll just divide it by 45. Those depreciable assets. But if it gets down to like 20, so if this is what's our operating life? Let's see what our operating life are. Our operating life is 30. So let's say this last expenditure you make in year 25 that's 2047. So you make it kind of close to the end of the life of the project. How are you going to do this now? So that's the hard part. That's the hard part. How do we kind of make a different depreciation life on some of our assets than on the other ones? And this is the kind of thing I think a whole lot of people would say, oh, just forget about that. Including me. Sorry. Certainly including me. So that's if the remaining life is less than 45 periods, just divide it by 45. But over here, if we have an asset, and here's our asset, I'm trying to explain this a little bit. If our asset is appearing somewhere here, where's our last asset? Come on. Here it is. Then our depreciation should be, because we only have 20 periods left, we're going to divide it by 20. Now this is a pain. It's such a pain that I often would just say forget about it. But I'm obsessed with depreciation too. I don't know why. It seems to be an old-fashioned kind of thing to be obsessed about. Well, a lot of these things are. And I shouldn't have digressed like that. I know I shouldn't have. So I have these functions for the depreciation vintage. And these things are as follows. If we have let me see. I'm going to go through one of these kind of vintage tables. This is what I used to do. I used to say, okay, we have a depreciation rate. And where's my 21? Where's the excuse me. Okay, I used to have a factor. Where is the S21? Oh, this is kind of bad. Okay, this is straight line depreciation. I have straight line depreciation over a life of it looks like 7 years. 1, 2, 3, 4, 5, 6, 7. Okay, and then what you could do is say, we're going to make a matrix. This retires in this period, and then we have another one that gets built in the next period. So in the second period, we have to add these 2. In the third period, we have to add these 3, so on and so forth. Then we take this one away, and this one has some life left. And you do all this thing, and you think you're so smart. You do a little thing with the age, and I used to be so proud of it. And I used the lookup function here to see when the rate changes, and it was all such a silly thing to do because you didn't need to do this. You could have used an offset function. Okay? Now, if we put a factor of 2 in here, so we have a changing rate, well, then you do have to do something like this because you have to remember which rate is applied to which age of the project. And I'm not wasting a whole lot of your time on this because instead of this, I think it's much better to make a user-defined function, which I introduced to you. And this kind of proves it. So this file called Depreciation Vintage Functions, which I'm going to put on the depreciation page. I haven't put it there yet. I'm going to put it on the thing. Now, that's all well and good if you just keep having a new asset and you don't have this remaining life problem I just talked about. If you have a remaining life problem, you can kind of do the same thing. And you just keep track of the remaining life down here. And if we get down, so this time I made a kind of scenario where we have a growth rate in our Capex. We have some Capex that grow from 100 up to whatever they are. And in the very last year, our Capex are 311, and we better depreciate that full Capex in that very last year. So you could make this long matrix, and really, if you have this problem with remaining life depreciation, you can't get around this. You have to do it. But instead, you can make your own user-defined function. And to make a user-defined function, oh no, I'll copy this, I hope, over to the next one, okay? Here, and you go through, and when you do this, I'm sorry, this is a little more complicated. I'm going to have to assign it to this one. This just is a little bit of a macro that finds the function, okay? So what you do is you go around and make a matrix. To make a matrix, you make two loops. This is the hard one. And you figure out what the age is, and once you have the age, you take your capital expenditure for one of the loops and multiply it by a depreciation rate that's a function of the age of the particular asset. And I'm saying this really quickly, and I'm not going through the whole thing. You can look at this yourself, but if you have remaining life depreciation, then instead of just taking that depreciation, you just divide it by the remaining life, and that changes over time, that remaining life. And then I made a third one, and this one was called, I'm going to go to the fourth one here. This one was called Depreciation Remaining Life 2, and this one I put a maximum. I said, okay, we're going to put a maximum remaining life. If it's less than the maximum remaining life, then you just divide it. Your remaining life is just the maximum life. If it's less, then you divide it by the lower number. So that was the idea. I hope you got the idea rather than the thing. So now what you do is this one, it's in the next one. It says remaining life at max. I don't know what to do. Now what I did is I tested it out to make it sure. I added up all the Capex. I added up all the depreciation, and it all works. And this thing down here didn't work because we'd have to make some complicated if statements, and it would get crazy a little bit. So that's our hard subject of this one. And so what you need to do is take this thing called Depreciation Life 2, and you press Shift F3, and you get the kind of Capex, the remaining life, and the maximum life. Those are the three inputs. This one is an array, this one is an array, and I didn't make a provision to take the entire life, take the entire thing. So this is a kind of another example of how you do this. Now to get this, I should have made a little whatever explanation, whatever. And we edit the functions, and this time, look, it says option base 1. So you know what I'm going to do? I'm going to just be lazy. I'm going to press Control C, take all of these functions. I hope I haven't messed things up by doing that. Well, I shouldn't say that, but and then I'm going to press Alt F8 again. Hopefully it will just take this one. And then we'll press, let's press a new thing, and let's call this DPR2 or something. Just something probably that you won't use. So we have a little subroutine, and we copy this into it. And remember, this was depreciation on the remaining life 2. So we have all our options to do things differently. And then we put depreciation on remaining life 2. This one. If I can't remember what to do, you press Control F3 and you get the Capex. You get the total Capex, the whole thing. And then you get the remaining life, which changed over time. And this remaining life was expressed in periods. And I hope the zeros don't affect anything. I'm pretty sure they don't. And then you put the maximum thing in. And that you don't take it. And then you press OK. And then it hopefully works. Okay. Okay, I got nervous with myself. It worked just fine. All right. And I don't know if this slows things down a little bit. there are a lot of, when you go through two loops like this, it's going to slow you down. I'm not pretending it's not. I haven't done all my famous, God, what an idiot I am. All my little tests on this one, okay? But here, this time we depreciated it over 45 periods. I believe, I hope, okay? All right, and then we go forward, and after we get to 45 periods, you stop. Here we stopped because we're finished with the second depreciation. And then we have another one, but this time we only have a remaining life of 20. So we take this total and divide it by the 20, not the forward one. Now, if you are really good at programming, maybe you could come up with some really long formula to do it. I don't think you could. So now our total depreciation that we have is this depreciation plus the depreciation expense that we have on our development fee plus the depreciation we had on our basic kind of capital assets. And then we have the depreciation for taxes, which is this one minus any, or how about I'll just do the calculation again, which is our basic depreciation plus the deductible depreciation, not the total, plus the depreciation on our assets that have a remaining life. Okay, and finally we can go up and find our EBITDA somewhere up here. And then we can find our deductible depreciation, not the total, and then we can get our EBIT. Okay, and then we can say, well, that without the NOL, we better find our tax rate. I'm gonna put the tax rate up here in this column. I still can't kind of come up, and why don't you help me? I have this 21%. Should I put tax rate in this little thing? I don't know. And then we can take that and get our taxes without the NOL that you hardly even need, because we really should adjust the EBIT for the NOL. So what we do is we say, okay, let's make the opening balance always equal the closing balance. Now, the only time you're going to be able to have increased the carry forward balance calculation is when this is negative. And if you put a maximum of a number or zero or some number, it will limit to a positive number. But we want to test if it's negative. So we just take that and that just switches it to a positive number. The maximum just switches it to a positive number. Now, we can do the same thing here. If we ever have to use this taxable income, we're only going to do this when it's positive. I went the other way around, and it really didn't matter. And then we put this one plus the amount we put in minus the amount we take out. Now, it's hard to envision this, but you would never, ever, if you don't have anything in your carry forward balance and you have a bunch of taxable income, you can't use it. So you use the opening balance with the minimum. Oops. And that's our first kind of max min. And then you take this EBIT, not the taxes, and you say, well, let's add the amount so that might be negative, and we'll add it to get back to zero, and then subtract the amount we use. That's the amount you actually get to pay. And then we put this amount in, and there was, if you care about U.S., there was a little change in the tax law that says I think you can only use 80% of this NOL, so we would have to make a little bit of a more adjustment to say usable NOL is 80%, and then it keeps getting carry forward, and it's not that big a deal really. And you multiply this by the fixed taxes, and then you get your taxes. I call these adjusted taxes. Taxes you would pay if you had no debt. So now we're going to go back to our we're going to go back to our pre-tax cash flow, and we're going to take away the taxes that were adjusted for the NOL. And then we have the adjusted tax flow. That's just like a free, regular old kind of cash flow calculation. Free cash flow calculation that you do in corporate finance and everything else. That's what I meant to say. Okay, we do this, and notice that that function I didn't make it absurdly slow or anything else. And then we finally get our project IRR, which is X IRR. And we take this number here and we then compare it, use the closing dates. Okay, and then we have our 5.79 after-tax project IRR compared to the 6.71. Now this IRR down here would have to be compared not to the interest rate, but to the after-tax interest rate, which is a little bit tricky because the after-tax interest rate have some things you don't deduct, the repayments, and some things you do deduct, the interest and the fees. So the after-tax IRR on the debt it's not the interest rate, it's lower than the interest rate. Okay? And that's that. That's that for the taxes. Now, once we have all of this, then we can go put in a balance sheet, and we can go through all of our financial statements before we put any debt in. And I'm going to do that because somebody told me to. And I think it was a wonderful suggestion. So then when you start adding more complicated things into your financial statements, then you can check them one by one without doing this horrible thing with the balance sheet check where you check them all. And I shouldn't have said all that because that's really part of the next video anyway.